Hey guys, Mike here. So today we get to answer all your questions, and there were some really good questions, very detailed questions. So I'm going to try to get as detailed as possible in there. And also I'm going to talk about a very important thread. I shared this with the members, but I'm going to share it with you guys and go through it in particular about what's coming up next week. Very important, or I should say this week coming up, about the bond market. It's really going to affect the stock market. Okay, so if you're in that, whether you're a swing trader, day trader, or long-term investor, you know, it's going to affect it in a big way. So I'm going to read through this thread I found. You guys asked for it, so I'll do that, and it's very short, but very informative. Okay, very informative. You don't have to know anything about bonds to understand this at all, and I'll kind of break it down into English. Okay, now first question here comes from Andrew. Let's just jump right in. It says, Mike, thanks for all the info this week. My question for next Q&A section: how does a swing trader on SPIRE QQQ know to sell longs April 15th? It seems too sudden of a decline to catch, and a rebound didn't happen. What are some better ways to notice something like this in the future and get to the sidelines faster? You guys feel free to put, you know, what you do on this. There's many different ways. I'll just go through a few you can look at before April 15th. And what Andrew's talking about is when we started the decline, right? Real steep decline. But what was happening before that, right? Even starting at the end of March, we were getting lower highs, right, and lower lows. And so, again, a lower high takes place when you go below the previous close. And so, and the same thing with the lows, right? And so, again, we got a pop up right here, and now we're coming basically into the area what he's talking about in that area right there. And so we were already trending down, right, on the shorter term time frames here, right? And so that was one indication of what was about to happen. Another one you can look at as well, we'll pull up moving averages, right? We'll keep it simple, and there's that 50, okay? And I'm actually going to get rid of the 200 and 100 because we don't need them, all right? The 50 and the 200 are very, very powerful. The 100 is basically a stepchild. But when you pull up the 50, you know, what was happening here, and I got extended trading hours on, so you can see this even better. Even in pre-market, we were bouncing off the 50 and bouncing, kind of wicking below it. And when the 50 breaks, you know, again, you can see on regular trading hours right here, which is what most people stay on. I like to stay on extended trading hours. Again, this is QQQ, but you can see it because I like extended trading hours because I want to see what's happening in pre-market, right? What are the futures traders doing and stuff? And so, you know, when I look at this right here, you can see, and the people that trade in pre-market, excuse me, but you can see when that 50 breaks, finally, it's like a dam breaking, right? And that's what happens. The 200 is basically the same way, all right? And so we obviously need to come up there and retest this. So using your 50 moving average will tell you this. If we kind of go back and look, you know, because remember, we hadn't touched the 50 the entire year, right? So it's very powerful when it breaks. Like the longer you go without touching it, right, then the more likely when you break it, you're gonna get a nice cascade down. It's gonna trigger the algos to kick in, people start selling, all that good stuff, all right? Because nothing good happens below the 200, and usually nothing good happens below the 50 either. But, you know, pulling, getting rid of all this stuff right here, coming back to the 50, if we kind of scroll back, I mean, you can see what I'm talking about when I say with the 50 here. A lot of times, even on moves up, right, you're going to be testing, but you can see when it breaks, these don't look like much, but, you know, these are 5 to 10% drops right here, right? And it tends to cascade down, and then normally you'll get a retest, and the retest is the key, right? And so we hadn't got the retest yet. But you can see, of course, that was 2022 we crashed. But, you know, on crashes, you're really looking more for the 200. In this case, it was the 50. So hopefully that makes sense. Now, another one you can look at, we can go into, people are going to pull up EMAs, right? They love EMAs. And you can pull up the 5 and 10, 3 and 9. There's different combinations I've heard of. It's like a million different combinations people like to use. This is like a 10 and 21, right? And so if you're a swing trader, you're probably more on long-term or higher time frames. But, you know, you look at the daily here, you know, when it crossed before the 19th, all right? And so it crossed up there kind of telling you, here we go, and it hadn't crossed all the way up, right? So that was another one. Another one you can use is your MACD, right? You saw on the weekly, I've been talking about this, how you had a bearish MACD cross happen well before the 15th, right? And when bearish MACD crosses happen on the higher, larger time frames, like a weekly, you know, it is a red flag saying, hey, you know, does it always play out? Not all the time, but most of the time, yeah, you get a nice, decent pullback on a weekly bearish MACD cross, especially when we were super overextended already. And so hopefully that helps out, Andrew. And let me know in the comments, guys, what, you know, you use if you're a swing trader to know to get the heck out of a position as well. Now for the next one, and before we continue, guys, please hit that thumbs up down there. It helps people find the video. I really appreciate that. And think about subscribing if you like these kind of videos. Zahn here says, hi Mike, could you please explain your methodology in drawing your trend lines for the channels you showed? I'm not sure which channels you're talking about, but I'll just kind of go through this. Because, I mean, trend lines are powerful. You'll hear people, and I think they're stupid, say trend lines don't mean anything, trend lines don't work, but I've showed a million times, especially longer term trend lines are extremely powerful. And I'll show you a few of them today. We talked about the one with Tesla last week, right? But again, all you're doing is looking for 3 touches. And it looks like I'm drawing a puzzle here. But once you start in a channel, whichever way you're going, or a trend, however you want to say this, right? It's all market structure. I'm just looking for 3 touches, right? And so it kind of lets me know if we're going to stay in this channel. It's amazing and magical how it'll come up to the top of a channel or the bottom of a channel. And he keeps bouncing for like weeks on end, right? It's amazing how that works. And you can see this channeling up, then we're going to channel down, then we're going to channel back up. And so once you get 3 touches, you know, I just draw the line, I extend it out before those other candles even appear, and you'll see it. It just keeps bouncing. We go to the 2022 crash, then we turn back up right before 2023. Now we're in this channel right here, and you can see these right here touch. And so again, that's where we're at, where we're going to come down and top, you know, touch the bottom of this channel on this move down in QQQ. That I don't know, but again, there's nothing magical about it. I'm not using any indicators. You just look for 3 touches, right? And then of course you're going to have more than that normally. As it goes on, you can use it. This is a weekly, but you can go on the daily. You can do a 5 minute, 10 minute. I know people use 1 minute, right? And you'll just see how it works. But understand what I'm talking about, the long-term trend lines. Let me show you a few. Tesla, we talked about the other day. Didn't matter what they said on earnings, how bad it was. This trend line is all that mattered, right? It saved it for the 2020 crash. It saved it the 2022 crash when it was going down 100 and what was it, $1 or something. People thought it was going to 0. And then of course the other day, as bad as earnings was, it bounced. Dollar General, I showed this many weeks ago, right? It had this very long, and sometimes you do a logarithm on this, but this thing goes back to 2010, right? And it bounced, way overextended, came down, didn't matter what. And this earnings was terrible, by the way, when they reported right here, didn't matter. The thing, since it bounced once again for like the 10th time or whatever it is up like 50-something% or something. So, you know, again, didn't matter. Disney was another one I showed you guys. It goes way back. I'm trying to rack my brain when I was trying to put this together to figure out some other ones. But if we go up here, let's look at, another one. And again, so that's logarithmic. That's not what I want. This one's actually just regular. Usually when you're going to an extended period of time, you're going to use logarithmic. Watch a monster. This one is coming into earnings coming up. And what's interesting about this one, you have to go logarithmic, right, to get this to work. But you go on logarithmic, it goes back to 06, this line right here, the trend line. And you see where it was support, resistance, bounced back up, and it just kept bouncing throughout the years on this one, right? That's where the 2020 crash came from, the 2022 crash came from. It just hit recently again, and every time it hits it, and what did it just do? Remember, this is a weekly chart. A week ago, it hit it. What's coming up? Earnings. We get to see, is it going to bounce or not? But again, you see that goes back all the way to 06. There's some that go back in the 70s, especially the oil stocks go back to the 90s, and they just keep bouncing off these long-term trend lines. So again, nothing magical about it. Just find some points that you can touch on this. They're called magic lines for a reason, I guess, or magic beans or whatever. But that's how I roll with it. So anyway, I hope that helps. Next one comes from Fugazi Bear. That's a nice little name. For your Saturday video, can you explain the difference between treasuries and bonds? And I mentioned this because obviously Janet Yellen, which we'll get into in a minute, has been issuing a ton of treasuries versus bonds. And there's a reason for this, and it's going to tie into that thread I talked about. But when we look over here, the simple definition before we even start talking about the thread, those who don't know, there are treasury bills, there are treasury notes, and there's treasury bonds, okay? Treasury bills have short-term maturities, obviously pay interest at maturity. Treasury notes have mid-range maturities and pay interest every 6 months. And then treasury bonds, which the ones you know are 20 and 30-year bonds, right? Have long maturities and pay interest every 6 months. Now, this leads us into the other one, right? And there's different ways also of taxing this stuff when it comes to these. But Light Dark here asks, please do let us know the link to what you read about bonds. And I'll put the link in the bottom. But when you look over here, this is from Alf at Macro Alf. He does a great posting on this. And he says, in a week, everyone, so make sure you pay attention here, everyone will be talking about Yellen and the quarterly refunding announcement. Here's all you need to know as you prepare for this thread. And it says, every quarter the U.S. Treasury publishes a set of documents highlighting their expectations for upcoming bond issuance, how much, and split between bonds and bills, okay? Their expectation for the size of the Treasury general account. So this is how they're going to be raising. This is how we fund our government, okay, and how they're going to do it. So Yellen has issued a lot, and I mean a lot of T-bills recently. It's like a record amount. T-bills now exceed the recommended 20% share of total U.S. debt. She does this to ease pressure on bond markets. This is the important part, right? The bond market is really important. Large physical deficits require large bond issuance, and T-bills are easy to absorb. And you can see by this chart, she has been issuing a whole boatload of T-bills. Again, the only time I think we've issued more was in 2020 when we shut down the world and they put $7 trillion out there into the market. And so they've been doing a lot. Now, because they carry very limited interest rate risk, a 30-year bond is roughly 20x more volatile than a 12-month T-bill. So do you want a lot of volatility in the bond market? No. You can imagine how, for market participants, it's easier to absorb trillions of T-bills, obviously, versus bonds. So important thing to watch will be the share between T-bills and long bond issuance Yellen plans to put forward over the next 1 to 2 quarters. The other crucial element will be the Treasury general account target, like how much money they want to put in the government's bank account is what this is. And he goes on to say, you can think of the TGA as the checking account of the U.S. government, which is the Fed. Every time the U.S. government has accumulated excess money that it doesn't intend to immediately channel into spending, they will park it at the TGA account at the Fed. And you can see when we go down here, after the ongoing tax season, Yellen will have around $1 trillion US in that TGA soon. That's quite high, and hence it's fair to expect a drainage to follow. But why does draining the TGA matter that much for markets and the U.S. economy? And if you look at this chart right here, you can see that it is going to start getting refilled up. And when we kind of look at this on a bigger scale here, you can see that was 2020, right? When they drained it and the market went up. So every time they fill it up and start draining it, the market tends to love it. And so right now they are filling it back up. So if they start to drain this, what is that? That is liquidity into the market. This is what the market loves. Remember, the market is an addict. What is your fix? Liquidity.
Listen, man, I just need some liquidity, you know what I'm saying?
And what happens is you get fresh new spendable money for the real economy, new liquidity reserves for the banking sector, and obviously it's extremely powerful, right? So the market loves it, right? This is what kind of saved us in 2020. Also what started getting us going and bottomed us out really in the bottom of 2022, at the end of 2022. And so they're going to do this April 30th. It's going to be this week coming up where you're going to get this announcement, right? So watch the price action in stocks and bonds. And he goes on to say, finally, a heavy issuance focused on the long end or a higher target for the TGA equals bonds and stocks sell-off. A low issuance focused on T-bills and a low target for the bank account equals short end bonds rally and stocks go to the moon. And so hopefully that makes sense, because we've been through this before. This is when the market started selling off back in 2023. I think it started at the end of July. There was Treasury issuance and it was a problem, right? They were doing it a little differently and it put stress on the market, right? And so again, if that's the case this time, the market will go back down. If not, the market will continue to moon, like he said. So hopefully that makes sense. And again, appreciate all your questions. Feel free to add to any of those answers and stuff, and put some new questions down there. I always appreciate it. And on your way out, please hit that like and subscribe button. Really appreciate it. And I'll see you guys tomorrow to set up the week after a huge rally on Friday. See you guys later.